This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 15th. Some highlights from today's show. The US budget is sending yields up towards 5%. Gold's correction is now officially over. And the US PPI data is very much in focus. Good day, traders, and welcome to the Daily Market Rundown. In terms of today, let's talk a little bit about the overnight session. Asia's quite soft. I think that's sort of the key takeaway. Asia's soft. We, of course, saw the commodities initially quite soft, the likes of gold and oil down quite extensively. We'll talk a little bit about oil in a minute. But effectively, Asia has maintained that softness. It's followed through a little bit into Europe, and I suspect it's going to be the same theme for the US, which is just somewhat of a soft session. Now, again, this is not necessarily unexpected. What we've seen pretty much all week is this sort of indigestion theme where the equity markets have staged such a significant rally, and now it's a question of what next. And we'll talk about that what next because, of course, we do have OPEX tomorrow, and that is a massive risk for the equity markets. But there's another key risk that we're going to get stuck in today, which I think is ultimately going to be pushing the equities lower in the near term. So let's get across and talk about our first topic for today, and it's very much all about what's going on in the US in terms of the Republican budget bill. Now, you've got to go read up about this. You've got to understand what's going on. We know that the package trying to be passed in the House is very much going to raise the debt limit. There's a general thinking that it's going to raise the debt limit by about $4 trillion over the next 10 years. And effectively, this runs almost completely opposite to what we heard going into the election cycle, which was, the Republicans want to bring down the deficit. They want to use Doge to save money, and they want to really kind of have a balanced budget. The reality is it's anything but that, and we can see that ultimately the market is now getting to work pricing in what this means. If they're going to pass this through the House, don't forget, of course, the Republicans control both the House and the Senate. If they are going to manage to pass this through the House as well as the Senate, we are going to have very much a fiscal situation where we're going to see a lot more spending out of the US. We're not going to be having the kind of savings that we were told we will get. And at some point, we are going to see those bond vigilantes wake up and really kind of start to test ultimately the muscle of the US. Now, it's very important contextually. We know, and this is key, January, February, March this year, we know fine well the bonds are very, very sensitive. So this is why this is a massive red flag for the markets. If this bill is going to get through the House, I suspect you are going to see that sensitivity come up. You're going to see the vol in the bonds pick up. That's going to follow through to the equities, and we are going to see those 5% 10-year yields come into view very, very quickly. Okay, what happens beyond the 5%? As I said, VIX is going to pick up, or the vol's going to pick up in the bond space, and we are perhaps going to see a little bit of a nightmare scenario for the US. Okay, the reality is the market sent a very clear signal in March, April to the US government, which is you cannot keep running such a significant fiscal spending program. You do have to rein it in. Okay, and I think that's the message we learned this year. And if we do ultimately get this budget being passed, I can tell you right now that's going to be the next major theme for the markets this year. Now, there's a couple of articles, and you can go read them. One's from the Bloomberg, one's from the Reuters. If you look at the Bloomberg one, they're kind of talking about, the last 2 years, we've of course had, fiscal spending of 6.4%, in 2024. In 2023, we were 6.2% debt to deficit to GDP. So we've had 2 years in excess of 6%. The general thinking is that as of this year, we're still currently running a deficit in excess of 5%. In other words, we are not seeing any savings coming from the US government. We're just seeing more of what the Democrats did. Okay, now why does this matter? Because, I've been going on about this over the last couple of weeks about, if you want some form of a sustained rally in equities and you want some sort of a buffer, you have to have some form of a policy response. Okay, and I think the general thinking is that the Republicans are going to spend lavishly, and that is the fiscal response that's perhaps going to keep the US economy from moving into that recession, and ultimately keep the stock market at these elevated levels. Okay, the key is is, if the bonds are going to push and above that 5%, they are going to force the hand of the U.S. administration to cut back, to change ultimately some of the giveaways, and as a result of that, if they're not willing to, then the bond markets are just going to keep going high in terms of yield. Okay, investors are ultimately going to vote with their feet on this one, and that's why this is a massive narrative that is starting to develop already. Okay, why do I think it's starting to develop already? Well, cast your minds back to March, April this year. The key theme was, why is dollar selling off in a risk-off environment? Okay, that was the first massive clue. Well, because investors are no longer confident in the US as the major safe haven. Moreover, we also saw that German bonds in the risk-off completely outperformed the US bonds. Okay, so what that was telling us was that the US bonds were no longer seen as the ultimate safe haven. Right? All of this ultimately suggests that if the US is not going to rein it in and US bonds are going to get above that 5%, you're going to see the dollar get hit very, very hard. You're going to see a lot of repeat plays from March, April, which was gold bid, Swiss franc, yen bid, bunds bid. And on the other side, of course, you're going to see the likes of the US equities down the page, as well as the US dollar down the page, as well as the oil market down the page. Okay, so it's very much, you've got to lean into that March, April tariff playbook, because I suspect you're going to get the exact same thing should ultimately the Republicans pass this through the House. Okay, now just a general, very basic overview of how this works. It's not as straightforward as pass it through the House. The first step is to get it through the House, to get some form of a consensus in the House. We know the Republicans have got that majority in the House and the Senate. So if they get it through the House, ultimately the general logic is that they should be able to get through the Senate, because they can obviously pass this via reconciliation, so they don't need the 60% vote to get it through. Okay. Now, we did see in Trump's first presidency, he did the same thing with the budget. He passed it through with reconciliation to avoid having to get the 60% and get the Democrats on board. So the key takeaway is that if it gets through the House, the general thinking is it'll most likely get through the Senate. Of course, there'll always be these giveaways. But the real sort of test is that we are going to find out now in the next 2 weeks, ultimately, whether or not this gets through. Okay, if it gets through, we're going to find out by the end of this month, you are going to see those yields push high. And there is that chart. This is the weekly 10-year chart. You can see pretty much we've done absolutely nothing, but we are back to those peak yield levels that we were during the tariff situation. Okay, and this is massively important, because if you think about what's happened over the course of the last sort of 2 months, we had the round trip in tariffs. That's not gone away. We know that we are going to be dealing with some form of inflation coming down the pipeline. And yet we are still sitting at 4.5%. Okay, this is the opposite of what the Treasury wants right now. The Treasury desperately wants to get some longer dated issuance done, and they don't want to be doing it at these sorts of yields. The point is what I expect you're going to see now over the next 2 weeks into this Republican House vote is I suspect we are not only going to take out that 460 high made at the peak of the tariff situation, but I do suspect we're going to move our way back up towards 480, 485. Okay, now, is it going to get there in a straight line? No, perhaps not, but I do expect the path of least resistance is very much for high yields, particularly if this budget is going to pass as it currently stands through the House. Okay, it's very much an inflationary type budget. It's very much a spend type budget, and in the current environment, in the current context where the US is dealing with a significant deficit to GDP, ultimately the markets are going to vote with their feet, and that means high yields. Okay. Now, this is my chart porn for the day. I love these chart porn charts, and it's something I picked up on not necessarily randomly. I look at it occasionally, but I've not actually read anyone talking about this, which is the 30-year yield. It's right back at 5%. Now, why is this chart porn? Well, because ultimately, this is the high that we made of 2024. Okay, and you can see that the last time we were up at these levels, the last time we were above these levels was back in October 2023, when we were, of course, having the inflation scare. Now, more importantly, what drove those 30 years up to that 5% into late last year? Well, it was the recovery in the US, accompanied by, of course, Mr. Powell, who came out and cut 50. So we had a very dovish Fed at a time when the US economy started to reaccelerate. What did bond markets say? They said, well, hang on a sec. You not only don't have inflation back at target, now you're getting very, very dovish without inflation back at target. And we do have an economy that's still solid. And we saw those bond investors really, really get out of those 30-year longer dated yields. Okay. Yes, that backed off. Okay, we came into this year, that started to back off, and that was effectively the top. But we're right back at those levels. Okay, now like I said, when the 30-year bond yields move, they never do. Okay, the reality is 30-year bond yields never move unless there is something significantly fundamental driving the markets. Okay, so when they move, we have to pay attention. Okay, if we get above this 5%, you're going to start reading about it. You're going to start hearing about it, and you're going to start seeing it on your screens because it's going to filter through into a number of different markets. If we get above that 510, which I expect we are going to be doing in the next couple of days and weeks, we are going to start to see a risk off come into the market. Why? Well, because keep in mind, right now we're starting to see much higher longer dated yields, and everything is priced ultimately against those longer dated yields. Okay, so right now, if we're going to scale those 510, we're going to see a lot of dramatic shifts in terms of financing. We're not going to see effectively anyone wanting to finance at these sorts of yields. Okay, so that is going to create almost a tightening effect on the economy at a time when we are seeing softening in the economy already. Okay, it's almost like higher yields at a time when the US economy is slowing will pretty much tip the US economy into a very low growth or even a recessionary environment. Okay, so keep an eye on that. 510, I do suspect we're going to get there in the near term, perhaps over the course of next week. I think we're going to probably be testing that 510, and then you'll probably start to read about it. Okay, that being said, of course, don't forget this 200-day moving average, which you can see in purple, is very flat. Okay, it's effectively been flat for the better part of 2 years now. So it's not to say that this is a guarantee we're going to break out of those 510. I suspect you'll probably need that Republican bill to pass as is, and then the market's going to vote with its feet. Okay, then it's going to say, well, this is going to prove to be massive inflationary. We're not going to be able to get the debt under control in terms of the interest payments, and as a result, we're going to need to see much higher yields. Otherwise, our investors are not going to be willing to hold on to our bonds. Okay, now, like I said, one of the key markets to pay attention to is gold. I do think this is very close to the end of the correction. What makes me think that? What's a number of things? I think, one, if you go look at break-evens in inflation, they are at the highest point of this year now in the US. So we're seeing break-even inflation rising. We are not seeing a rebound in the dollar. And I think gold is very much being bought as an alternative against holding dollars. And at the same time, we've now washed out some of that risk-off theme that we had as a result of tariffs. Okay, but what we're currently seeing is that traditionally when yields push higher, we normally see gold go lower. Okay, and we've seen a little bit of that. We can see how over the course of the last couple of sessions, those yields have pushed higher, gold has come off. But gold's come off on a combination of a little bit more risk on, a little bit of a dollar bid, and a little bit of higher yields. Okay. The reality is, though, this correction is now 11% deep. Now, if we go look at the last 5 corrections, we can see all the way back to the start of this rally at the start of 2024, we had a correction of 634, then 5.2, we had a 9% correction, a 4% correction, a 6% correction. Okay, this is the deepest correction we've had in gold effectively since this rally began. Now, it's not to say that it can't continue. Of course it can. Okay, but the point is that the corrections have been relatively shallow. They have not been aggressive corrections, and for good reason. Everyone wants to own gold. In the current environment with higher inflation, particularly higher inflation coming in the near term as a result of tariffs, as well as, of course, the scenario where we are seeing money move out of the dollar into alternatives. I do suspect, if we haven't yet already found the low today, I do suspect we're very close to that low where investors are going to start buying up the shiny metal again. So keep an eye on gold. Then, in terms of the S&P, and I think just in general, what we are seeing now is indigestion. What do I mean by indigestion? Well, when a market stretches a bit too far, okay, like we've seen in the near term, what typically happens is you need some form of an initiative to continue up, okay? In other words, the way to think about this is everyone bought down there, then more people bought up there, then more people bought up there. You now need an impulsive initiative to take place at these highs, okay? Now you got to ask yourself, who's going to buy it at these highs after the degree of this rally? Okay. Also, given the fundamental backdrop, who is naturally going to buy it now? Now, yeah, sure, you can argue if the VIX starts to move low or continue to move low, the CTAs will be actively buying it. Fine. That's one natural buyer. But what we ultimately need now for equity markets to push again is we need some form of a catalyst. Now, that can come in the form of a really solid NFP print next month, or it can come in the form of, perhaps a dovish Powell. There's a number of things that could drive that initiative above the current levels. But until we get that impulse, the markets are now going to have to try and absorb and find some sort of value. So what I expect to see over the next couple of trading sessions is just a bit more sideways trade between this 5,900 and perhaps the 5,800 level. In other words, settle into some form of a range until it gets a catalyst. Now, that catalyst could be positive. Like I said, it could be a really solid non-farms, at which point, fine. Solid growth, US economy is reaccelerating, we're off to the races. But it could also come in the form of a new negative narrative, which, like I said, you get a 5.1% 30-year yield That's the new narrative that's going to drive this market, not just down to 5,800, but substantially lower. Okay, you've got to be switched on now for a switch over in narrative. Of course, we're very focused on the macro data, the hard data. We know that that's something that can confirm a potential recession, but we're also now focused on this budget, because if that gets passed, yields push higher, we're going to start to see that tightening effect filter into the risk market. Okay. This indigestion is probably going to continue for a little bit longer. We do have OPEX tomorrow. Once that clears, we know that natural hedging that is supporting the market up at these levels is ultimately going to disappear, and that may open up the downside a little bit more. So keep an eye. If I was going to sort of, gun to the head, take a little shot, I would say don't be surprised to see those equities start to offer post the OPEX tomorrow and, of course, into next week. Okay. And then finally, we do have the PPI today, and I think there's a fantastic tweet out from Jim Bianco. If you're not following him, there is his Twitter handle. Make sure you follow him. He's really fantastic. And he's talking about this concept of who's paying for these tariffs. Now, what he's leaning on is this idea of the CPI on Tuesday was soft. Okay, and so his thinking is that because it's soft currently, it's perhaps not the consumer currently paying for the tariffs. Therefore, the next place to look is the PPI, because if the PPI comes out soft today, then it confirms that perhaps it's not the importers that are paying the tariffs, which means that it can only be one person that's currently paying the tariffs, and that's the Chinese. Now, logically, if you think about what happened, March, April, we went into this massive fight, and all of a sudden the US and China stopped trading with each other. Okay, but don't forget the Chinese had all this product. It was sitting in their factories and they had to do something with it. Now the result is you can do one of two things of it. You can effectively try and force the buyer to pay a higher price, or you can take a little bit of a hit in terms of margin. In other words, make no profit, send it over to the US at cost price just to make sure you offload the inventory. Okay, and I suspect that's probably what happened, which is the Chinese absorbed the initial impact of the tariff. Why? Because they don't want to lose the buyers. They don't want those buyers suddenly going sniffing for other buyers around the world. Okay, so the Chinese probably absorbed the first part of the shock to ensure they don't lose market share. That's very, very typical business 101. So that's why we're not seeing it crop up in the CPI and perhaps not even in the PPI. But we're going to learn today because we have got that PPI up. In other words, if you see a sudden tick up in that PPI, that starts to confirm that perhaps the buyers or the importers were sharing some of that impact with ultimately the Chinese. But don't be surprised to see that PPI come out completely in line. If it does come out, of course, hot, that is going to point to a situation where that inflationary impact is going to start to filter through into the economy first with the importer, next to the consumer. Okay, this is the logic. This is sort of the second and third order now of what everyone's talking about, which is we're going to start to see those higher prices filter through in perhaps the June and July inflation readings. Okay, but it begs to be seen. We don't yet know if this is going to be inflationary. Today we'll get a little bit of a clue via the producer prices. Okay, now you can go on and read this. I think it is Jim Bianco's tweet. Go and read his whole tweet and you can understand the logic. But at some point we're going to understand the nature of who is paying for the tariffs, because someone is. Okay, guaranteed someone has to be paying for these tariffs. I think he goes on to say there's about 7 billion of tariff revenue that's come in. Someone's paid for that. Either it's the Chinese, I suspect it's them initially, but at some point that's going to get passed over into, of course, first the importers and then the consumers. All right, that is then, of course, a wrap for today. It is very much a day where we get the initial job list coming out as well, and then we hear from Chairman Powell. Not expecting anything from him, but you never know. I mean, Chairman Powell's a funny old one. He kind of keeps a tough stance, and then he flips his book almost unexpectedly. So we do pay attention. And like I said, if he is going to flip his book, it's going to be in a dovish vein. Why? Well, because ultimately, we did see that softer CPI. So not expected, because like I said, he told us a number of times we have to wait to understand the implication of these tariffs in the next couple of months, and it's premature to even start talking about rate cuts. Okay, so keep an ear on it. It is something that's likely to be a non-event, but we do have to pay attention to it. Okay, with that in mind then, if there are any other questions, do post them in the Discord channel. Otherwise, also don't forget to comment. It's good to read some of those comments. If you like some of the content, tell us what you like, tell me what you like, tell me what you want to see more of. Particularly comment on the chart porn, because that's a fantastic chart that I've not heard anyone talking about yet. That's it for then today. Good luck out there, manage that risk, go make some money.